Good afternoon, Easy Properties investors, and welcome to our first webinar for 2022. And watching that introductory video and seeing some of those amazing images of the Rockefeller, our newest property, I'm even more excited about what we've achieved together. So I'm joined today by Rupert Finnemore, who is no stranger to you guys. He's the CEO of Easy Properties. He's fanatical about a few things. Property is top of the list. So welcome, Rupert, and thanks for joining us.
Yeah, thanks, Carl, and welcome to everyone on the call. It's great to be on our first webinar for 2022.
Yeah, and no pressure, but we've told people that you're going to give them some hot investing tips and specifically property investing tips, Rupert. We're going to keep this short to 30 minutes. But please use the chat function. Everybody on the call, add your questions in there and comments, and that will guide us what we're doing next. As a reminder, we've got an Insta Live next week where we're going to talk about Cape Town property specifically. And the week after that, we're doing a webinar again, and we're unpacking some of the property terms to help you with your investments. But please make any comments and questions that you've got. We want to help you and give you as much information as possible to make some good investment decisions. We've got a little bit of a surprise and an update on a property, and I'll talk a little bit about that afterwards, but we're going to get straight into it. We're going to go to our first point, and we put up our slide of our first tip, Rupert, and it's diversification, and that old expression about don't put all your eggs in one basket. So maybe we want to talk a little bit about why property investment diversification is such a big important part.
Yeah, I think, Carl, I think this diversification plays two important roles. I mean, obviously as a spin-off out of Easy Equities, a lot of our investors would have come from the equities market. And obviously diversification is about managing your risk. So with a large part of our community having started the investment journey, investing in the stock market and equities and things like that, it's just a really good thing to be able to diversify and invest in bricks and mortar. Is obviously one. It's about managing a person's risk and exposure. But I think equally importantly, if you are investing in property, it's the ability to actually diversify your property investments as well. There's talk about one egg in one basket. If you own an individual rental property, you and I get together and we buy a rental property wherever in Sandton, and that tenant either doesn't pay the rent or it stands vacant for a little while, we've obviously got 100% exposure to that property. So then you and I are in a bit of a pickle when it comes to paying the expenses and things like that. So the fact that one is able to diversify and invest across many different kind of properties at Easy Properties obviously just helps mitigate the risks of having all your eggs in one basket as well. So I think it's kind of twofold.
Thanks. And Rupert, I think we can also add that we're increasingly diversifying the properties that get listed on the platform. And there's already been a good question, how do those properties get selected? And so we're looking at properties in Cape Town, we're looking at properties in Durban, looking at properties in Joburg. So there's geographical diversification as well. And whilst all our properties to date have been traditional residential apartment type properties, we're also going to be diversifying into commercial, student accommodation, a whole bunch of other properties as well.
Yeah, absolutely. And I mean, that diversification also goes geographically, not only within our borders, but across borders as well. So we are looking at some international property as well. I think one of the nice things about having this collective power of our Easy Properties investor community is that we have a lot of developers approach us all the time looking to give us their properties to invest in. If someone asked how we go about choosing these properties, we've got a very stringent investment criteria. So we have an investment committee that is made up of finance experts, business experts, property experts, all of that stuff. And we analyze that, we do a proper due diligence, and only if these properties get through that investment committee do we look to then bring it onto the platform.
Yeah, absolutely. And I think an important point there is we don't just list anything on the platform. However, if any of the users have got leads and tips, you can look on our website and there's a facility there where you can be in touch to let us know about properties. But the idea is that whatever we put on there is property that we're comfortable with will lead to returns. And just as a reminder, we're all investors with you. It's every person on the Easy Properties team is invested alongside you as well, which is important for us. So if we look at the next image that we've got in terms of tip number 2, so we've done diversification. Second up is leverage, Rupert, and maybe you can just simply explain what does this mean about how do we use other people's money for our own benefit as property investors?
Yeah, so essentially leverage is obviously using the bank's money to help purchase a property. You know, it is one of the benefits.
You're not all property nerds like you that know everything. That's why you're here giving us tips.
I say obviously, actually, because most of the investor community are much smarter than you and I. So I'm saying it's obvious to them, perhaps less so for you and I. But yeah, it's using the bank's money to generate a return for yourself. You know, obviously, when one buys shares, you put 100% of your cash in and you buy your shares. I mean, there are instruments to do that leverage, but that's a different story. But the nice thing about property is that you don't have to have the full 100% of the purchase price in order to invest in property. As you know, on Easy Properties, we only raise 70% of the total purchase price. And we specifically decided to take a 30% mortgage on these properties. And that's to give a little bit of gearing to the investment, which means that we generate a return. Now, the yield that we get from these properties gets bolstered on the bank's money. So obviously that bank's money comes with a portion that one's got to repay. But the idea is that you're getting a full return on your 70% that we put down. And you get a return, hopefully, you know, it's got to be obviously better than the mortgage that we're paying back, the debt that we pay back on those mortgages. But you're able to kind of ramp up your returns using the bank's money, obviously, so long as, you know, the returns are higher than what your repayments are.
Yeah, so simplistically, if we're investing as Easy Property investors in a bunch of apartments and we need 20 million to buy them, we raise 15, 16 million from all of us. And we borrow the rest from the bank, and that's the leverage that you're talking about.
Yeah. And I think the one thing about that, you know, Carl, a lot of people have asked, why don't we just raise the full purchase price, you know? But again, it's specifically so that we can generate a return on the bank's money for our investors. So basically, you're putting in 70 cents and you're getting exposure of R1 to the property by being able to leverage it. And that's the way one's got to look at it.
Cool. So we're going to go to the next point, which I want everybody to look, because Rupert is going to go bright red in his face because he gets very embarrassed. So we're going to talk a little bit about tax and the tax benefits of property investing. And maybe in the beginning, Rupert, you can tell us what is the SARS directive around this?
So there's a section in the Tax Act called Section 13. And weirdly, some odd tax commissioner was sitting there. When he decided to name this particular one, he decided to call it the Section 13 SEX incentive. I've got no idea why. But yeah, it's one of the tax incentives that we get to enjoy at Easy Properties. And, you know, a lot of these incentives were brought in to help stimulate the economy, to drive investment into particular areas, property development, you know, all of that kind of stuff. That obviously generates jobs and all of that. You know, it's a real cornerstone of the kind of economy. So what that Section 13 SEX does is that if you buy at least 5 units directly from a developer, and that they are brand new, and as an investor you don't use it as your primary place of residence. Obviously, we tick all of those things. We've got multiple units. We buy our units from straight from the developers. They are new, and obviously we don't use it as a primary place of residence. Then we are able to write off up to, it's 5% of the purchase price per year over the term of that, you know, over the 20 years of the property, which basically means, as an example, if you buy 5 units at R1 million, over that period, you're actually able to write off about 2.75 million of that purchase price in depreciation. So it's a major incentive to the income that you're generating. So that's the one. That's a really good tax incentive. Another good one is it's also Section 13. It's called BIZ. Section 13. Someone just said, do I qualify for sex tax if I invest in easy equities? That's a question one would never have thought to have read. But I am going to start blushing in a minute. But anyway, Section 13 BIZ is another tax incentive that we are able to enjoy. And this one's generated around the hospitality. So, you know, with our black brick investments and this Rockefeller, the second Rockefeller investment that's gone into this hotel pool, because they are primary investments in hospitality and the hotel environment, again, we are able to deduct the cost of refurbishment and setting it up in order to use these as a hotel and things like that. So there are a lot of tax incentives around investing in property. Those are obviously just the two big ones that we get to enjoy.
And Rupert, just to pick up, because some of the questions also allude to this, as a reminder to all our investors, any income from the properties that we own, so whether that's the initial interest we get on the cash before transfer takes place, the rental income, any tax benefits, all of that income minus the expenses is what we get as dividends.
Yes.
And so finding ways through tax to maximize income flows directly through to us as investors. So that's great.
Yeah.
I'm going to push on.
I think just on that point, Carl, maybe it's just good to remind our investors that we pay out the full 100% of those profits. Obviously, you know, we guys who've been investing with Easy Properties from the beginning know that we withhold a little bit, 15%, just to carry us through periods of vacancy or bad debts or tenants not paying. But at the end of that investment period, we release all of that money back to investors. So we pay out 100% of the profits.
Cool. So next up, we've got a tip around stability, bricks and mortar. So if you can briefly talk to us about that, Rupert.
Yeah. I think that's one of the old adages of property investment. You know, one only needs to look at you know, some of the volatility in the stock market, and maybe even now for some of the guys who enjoy investing in crypto. You know, it's so volatile. Those kind of prices drop a lot. You know, if one has to look at Steinhoff, if you had put a whole bunch of money in Steinhoff all that time ago, and that share price fell to the floor, you know, there's risk in equities. Obviously, there's huge upside as well. But ultimately, being able to invest in bricks and mortar, traditionally, it's viewed as a slightly more stable investment that won't necessarily generate, well, definitely won't generate the returns like crypto and things like that. But it's just a steady, good investment. And at the end of the day, you've always got that assets, the bricks and the mortar of the property to fall back on should, you know, the financial tide go out. You've still got an asset there that you are able to liquidate. And yeah, that's why obviously people talk about investing in bricks and mortar, that there's a physical asset there that, you know, will always be there.
And for those investors that are with us today, many of you post on our social media when you're driving past the Rockefeller, when you're driving past the Reed, one of the properties we've got up now, any of those properties, because we're part owners, and we love seeing that. So you can physically go check out your asset, and you're a part owner in those assets, which also changes the behavior. So it's very important.
I get a real kick out of it as well. You know, when I drive around after picking up my kids from school and we drive past Black Brick or whatever the story is, we always get a kick saying, look guys, there's the Black Brick, you guys own a little tiny share in those properties, and you always get a kick out of it. It doesn't matter whether you own 0.1% or 50%, you're still an owner.
Cool.
Yeah.
So there's just been a question posted now, which leads us to the next point in our fifth tip, which is guaranteed returns. So what do we mean by guaranteed returns? I mean, for instance, at the moment, our REIT property that we've got listed, which you did some Insta Lives for us this week, and they, you know, they were amazing just to see all the green initiatives and other benefits of this property. But we also say that there's a 24 guaranteed return there. But what does that mean?
Yeah. So part of that investment committee, obviously our, again, long-standing Easy Properties investors will know that we've got a relationship with Narrative. They're our property partners. So they go out and they negotiate these deals on our behalf, obviously using our collective bargaining power. And as our size of our collective checkbook is getting bigger and bigger, we are able to negotiate guaranteed rental returns. So what that basically means is that we buy these properties from the developer. So in the instance of Baldwin, in the instance of the Reed, it's obviously a Baldwin development. So Baldwin have guaranteed us that rent that we've put into the prospectuses for 2 years. So there's no pressure in us having to find tenants or any periods of guys not paying or any periods of vacancy for that full 2 years. They've guaranteed us the full rental income on every single one of those units. And that's a rarity. I mean, that seriously de-risks your investment. And so obviously after the 2 years, it's then up to us to find tenants, but it's just such a pleasure to be able to take ownership and transfer the property when you've got a guaranteed rental in place. You know, if it's a property without a return, then obviously you take ownership of the property, and then at that point you start looking for a tenant only when it's yours. So, you know, I actually don't think we make enough of a big deal about this, that we do have these, you know, rental guarantees. I mean, some are 18 months, some are 12 months, some are 24 months, but to be guaranteed a net return on your investment for at least 2 years is really, really quite extraordinary.
Yeah, and it de-risks the investment. So we're going on to passive income, making the money flow. So do you want to talk a little bit about that? And this is tip number 6.
Yeah, it's a great photo. If only it worked like that. But yeah, passive income, and that's also one of the benefits of property. You know, you in this buy to let space, we are purchasing this collective property and collecting rentals. The passive income obviously comes as and when we build up our portfolios and we are generating dividends for ourselves across all of these different properties. You know, the fact that Easy Properties manages it on behalf of all of our investors, we look after the units, we rent out the units, all of that stuff. We deal with all of the headache aspect, really makes this a passive income for our investors. But it's the ability to generate, you know, dividend returns and dividend income for yourself, you know, as an additional revenue source.
Absolutely, and we've seen some hell of a smart investors. I mean, Easy Equities is now, we're edging towards 2 million investors. Easy Properties, the community has grown significantly, and we see a lot of our investors looking towards dividends from their equities, from Easy Properties. People in their 20s and 30s are really planning ahead to get those dividends paid, which is super smart.
Yeah, I think, Carl, just on that point as well, sorry, talk about passive income. We paid out, well, our investments paid out over 2.1 million Rand in dividends last year. So that was 2.1 million Rand of passive income that we were able to share out into our investor community, which was a wonderful figure to hit that within the year.
Cool. We've got some questions around dividends, and the specifics around that you can look at our FAQ section, which has a lot of information, and also on our website and in the prospectuses. And as a reminder, our next round of dividends will be paid in February. I think the exact date's the 20th of February will be the next round of dividends, and all of that information is on our website as well. Next up is that property investments are hedge against inflation. Tip number 7. Rupert, talk to us about this, please.
So again, obviously with inflation, that's the, you know, inflationary increases in costs. It increases one's general cost of living, things like that. Property is considered a hedge against that inflation for kind of 2 reasons, especially in this property, the kind of buy-to-let investor space. First and foremost, you know, one is able to build in increases in your rental income, you know, during the period of a lease. Generally, those are done at inflationary figures. So every single one of our leases that we sign on behalf of the investors, we build in a 4.5% annual increase in that rental. So that's a hedge against inflation. As inflation increases, we're able to increase the amount of income that we are bringing in on each of these units. Another hedge against inflation is, again, the steady track of increasing prices, property prices. Obviously, it's been quite a tumultuous period over the last little while, but I was having a look at a few stats earlier. And just from 2020 to 2021, as an example, the Cape Town property market in 2020 increased by 3% in terms of its average house price. In 2021, it was 4.3%. Joburg went from 1.7% in 2020 to 3.6% in 2021. And interestingly, our friends in the Eastern Cape have really been enjoying it. And maybe we need to start looking for some property out there. But their house price growth last year was at 7.6%, which was the highest in the country. And so because your house prices are growing by that rate, it obviously is, again, a hedge against the increased costs that you're facing. I think also, Coral, one of the benefits of us having these multi-unit investments, again, if you have one unit and you have a tenant in it and you're able to increase your rental by X% every so often, well, every year or every 2 years, it depends. Sometimes in commercial properties, you sign a lease for 4 or 5 years or 20 years, and you get tied into that. But one of the really cool things about us doing these multi-unit developments, as an example, the Reed, we are purchasing 25 units there. Obviously, after the rental guarantee period is over, we're going to have 25 leases expiring and renewing at different times. And each one of those kind of occasions is an opportunity for us to make sure that our rental is market related, to increase it by inflation and things like that. So kind of for those reasons that properties are, a good hedge against that.
And just to remind users as well that all of us, we're looking, this is not a short-term investment, but we are looking 3, 4, 5 years out that we'll be selling some or all of these. So in your example of the Reed, we might sell a couple of those units and keep some others and return profit to all of us as investors. And so all of those are options that are open to us.
I think that's just also a very important point, and we need to just underscore that the whole time. Property is a long-term investment, medium to long-term. Guys who are looking to invest 1,000 Rand now and turn it into 1,200 Rand by the end of the year, property is not that. That's crypto. That's the crypto space. Or thankfully, a lot of our purple shareholders have enjoyed those kind of returns over the last while. But property is a solid, dependable kind of investment. And in order to generate those full returns, you've got to kind of stay in for the full 5 years. You generate the most returns, you generate the most capital growth, and all of that. So it's really important just to always remember that it's medium to long-term investing.
Cool, Rupert. And now number 8, your tip there or your point there is that anyone can invest, that no specialist info is needed.
Yeah. If I think of investing into crypto, I mean, I love EC10. I know absolutely nothing about crypto and the graphs that draw and post and discuss this and the fundamentals of that. For me, that's specialist information. And same when you are, doing financial analysis of different companies and things like that. For property, you don't really need to do that. I mean, it's simple. You're looking at property in good areas. You are looking at properties that have a certain rentability. And then you're looking at, it's very easy to determine kind of value. When you see comparable sales in an area, I mean, all of that information we make available on our platform, but it's all available on Property 24. You're able to see what good rentals are on properties in certain areas. And it's kind of as simple as that. I mean, obviously one's got to work out the costs and things like that, but it's really is investing for everyone in comparison to some of the other complicated investment schemes and products that are out there. So I think that's also one of the big benefits of property. And of course, with EP, the fact that we have spent all of that time breaking it down doing all the hard work. I think it just underscores that, literally with no minimums, anyone can invest in property.
Right. Thank you very much, Rupert. And so those were 8 tips. We've got our last slide, and maybe just briefly put that up, which was, I'm going to talk a little bit about 9, 10, and a couple of other tips. We're going to keep this to past. So just a few general things. Firstly, this will be available on YouTube, the recording, and we'll also put up the slides. In the next week or so, we're going to be talking about each of these slides through our social media and on our blogs, etc., and unpacking it a little bit more. And Rikus, you can drop that slide. It's fine. Thanks very much. Giving some more information. But I want to give all of you, because you're our favorite Easy Properties investors, who should join us for the seminar, some heads up on some exciting things that's happening. Our read is open for another 3 days. We've seen massive interest in the read in the last day. We're close to 60%, and we've had a number of investors deposit some money, and I'm confident that by the end of today, we'll be at over 80%. And then the great thing about Easy Properties, even when the markets are closed, you can be investing. So we'll be well over 80, and then it's up to us to get that across the line, if we believe that this is a property that we want to get across the line. And judging by the massive amount of interest and the stuff that Rupert put on social media, I think we will do so. So check that out. If you go to support.easyproperties.co.za, most of the questions that people have been asking is answered there. You can just simply type it in, and most of the answers are there. Very quick, succinct, and easy. Support.easyproperties.co.za. Most of your questions are answered there. Our next
Coral,
property.
can I quickly just answer the one question that's come up here, which I see 1 or 2 people have commented on?
I'm going to hand over to you at the end, so keep that there, and
okay.
You can continue. Yeah.
Okay,
so
cool, thanks.
The updates in terms of our communication. Our next property is going to be in KZN, and we'll be sharing a lot of that and some competitions. Auctions are happening, as I said, in February, dividend payments, and we'll be sending information out on all of those. We're going to be publishing a little bit of a newsletter in the very near future with a summary of all of our properties that we've got. Some of our users, many of our users, are invested in all of them, some only in 1 or 2. But we're going to remind people of the rental income that's been received. We're going to talk a little bit about when future auction dates are for those specific properties, and just give an update on each of those properties so that all of us as investors know exactly where our money is, how it's working for us, and you can ask any questions then when that comes out, and that will be in the next couple of weeks. Lots of questions about what's the minimum. There is no minimum. You can invest anything. We have investors that put down a few rand, and we've got investors that put on a few million rand, and we love all of those investors equally. So there's no minimum. Rupert, the question that you wanted to answer?
Yeah, I saw Melissa posted a question there around the management reports and the kind of rental management reports as well, the financial reports. Yeah, absolutely. Those are going to be published. We've just moved over onto a new management system to look after those properties. They've got great reporting tools there. So yeah, by the time we pay out these next quarterly dividends and with the auction, those reports will be available on the platform under each of the properties, a full set of high-level management accounts and full reports in terms of vacancies and collections and all of that. So yeah, that's definitely going to be there. I saw someone asked around the tax. Just a quick one. Obviously, when we pay out dividends, there's dividends withholding tax at 20%, which is applicable. So the money that hits your account, we've already taken that dividend withholding tax off. So the tax is sorted on your dividends. And then someone else just mentioned something around retirement. And I think that's one of the things that we are focusing on in an enormous way for 2022 is just delivering a more interesting product mix. And as you mentioned, Carl, I mean, there's going to be commercial, international, hopefully some good commercial and retail stuff. Yeah, and retirement is definitely one of those. We've looked at a couple of retirement opportunities, student accommodation, the work. So there's going to be some really, really interesting assets coming onto the platform.
Cool. I'm going to spend just 3 minutes trying to answer a couple of the questions, just very briefly to see which ones I can get through. But thank you very much, everybody, for joining again. And as a reminder, check out the read that's listed at the moment. Also Rockefeller 2, those are both great properties for you to consider in your investment. We've got a question around how long do we extend an IPO? Target isn't met. And the short answer is we don't always extend it. There's some flexibility with that, but we don't always extend it. And our view is that you the users, decide which properties are successful and which are not. So our job is to give you as much information on the properties and for us to decide. We've had a good track record because of the due diligence and the quality of products that we put up. There's a question around how do we do due diligence? Those are the people that Rupert spoke about, property experts, finance experts. From a brand perspective, we give input. But the idea is that we put properties on there that we're all comfortable to invest in, that we're comfortable will in all likelihood generate a return for us in the investment period through dividends. And then when we sell it, that there'll be capital appreciation. There's no guarantee with this or any of investments. And obviously, you know, we can't give advice. It's dependent on each individual person. But that's what we look at, something that will give capital appreciation. The one here about dividend schedule, that's on the website. The auction one is also being updated, so you can see all of that. Recording will be on our YouTube channel. There's a question about how long does it take you to create your account? I know we've got Wayland from our client engagement team on here, our brilliant client engagement team. And with the work that our digital assets team and others have done, it literally takes, you know, a minute or two to open an Easy Equities account and to activate your Easy Properties account. It really is very simple and easy. We had a question here which I wanted to touch on from Kay Rubin, saying, I can buy my own property after 20 years I own it. What's the advantage of Easy Properties? And I think those are some of the things that Rupert spoke about. Diversification, because you can own a share in many properties. You don't have to be responsible for any of the management of those properties. All the hassle is taken care of by the team at Easy Properties. There's often a guaranteed return up to 24 months we've seen, as Rupert mentioned. So there's many benefits to that. Unfortunately, we have to stop there, but I want to repeat that we're going to be putting out a newsletter. I want to touch base with what Rupert said, that we are continuously inspired by the smart investors that we have. Rupert, how many Easy Properties, exclusive Easy Properties investors do we currently have?
So we've got about 260,000 people that are registered, and we've got close on 60,000 people that have actually put their hard-earned cash into the different property investments.
And we're about a year and a half old. We started during lockdown, so we started in a difficult period, year and a half, and putting you on the spot, our property portfolio. So the hundreds of people on this call, you and me, what is the property portfolio value that we own?
Sure, it's well over 200 million Rand.
So just to put that in context.
Over 130, 140 individual units.
Yeah. So many units, well over 200 million. That's us, retail investors, people that were discounted before. I mean, I am extremely proud by that. Again, we've got investors that put in $5, people who put in, you know, millions. But for us to collectively and, you know, not even a year and a half to have grown a property portfolio like that is phenomenal. The stories that we're hearing about people, you know, really wanting to create generational wealth for their families is phenomenal. So that's why we get up every day. We love your feedback. We love your challenges. When we drop the ball, please tell us. We'll apologize and we'll fix it. Big shout out to our Easy Properties team that are on here as well, the client engagement team. Everybody helps us. You're great. Our partners at Narrative. But in conclusion, a massive thank you and congratulations to all of you as property investors. You are growing your wealth, and we're excited to be your partners on this journey. So thank you very much. Thank you, Rupert. And we'll see you guys next week at our Insta Live. Have a good rest of the day, everybody.